That's like the covered call where you say, okay, I'm willing to sell these things because I'm trying to lower my risk and I'm getting near a point in my life where I could use a little bit more income. So my S&P is paying me 1.5% and my bond fund is paying me 4%. I know I should sell some, and this might be in a tax-free account, an old K or IRA, and you sell a call option a little bit higher. And until it gets there, you just take that extra income. And so if you generate 2 or 3% from each option and you write them out 3 or 4 months, then you do that 3 or 4 times. Now all of a sudden you're taking in 5 or 6% income on those shares. That's a nice way to increase the yield and wait for it to get to a price that you'd feel good selling. And so when I think about options, they create, you guessed it, more options for you. And the idea is there's uncertainty in everything we do. There's uncertainty in the weather, there's uncertainty in health, there's uncertainty in everything. And so what you're doing is trying to profit from that uncertainty. And there are times when I look at an option and I say, the historical volatility of this is 18%. Now it's at 26, 27, 28. So it's paying 50% more than it normally pays because the option price is based on that volatility and uncertainty. So therefore, do I think it's 50% more likely that it's going to hit that price? No, I don't. I think that volatility bounces up and down around a mean. And what you should do is when things are priced in a rare way, meaning higher than normal, I think you should try to take advantage of it. When options are particularly low, I've seen them get down to 9, 10, 11%. And then I said, I think I should buy protection because the protection cost just got less by 50%. This happened after the recent Venezuelan move where we took and arrested the president there, Maduro. I don't think that arresting the president of Venezuela is necessarily a reason to think the market is less volatile. But that's what happened. So when the market gives you something, you have to ask yourself, it's giving me this. Do I believe it? Do I think that's a good idea? And so I bought put options for a couple of the clients during that time. And it's really about trying to create the right feeling for our clients. Clients can feel very anxious about many different things in the world. And our job is to really help them understand the price of oil going up. What does it mean? The carriers going to the Middle East. What does it mean? All of these things are troubling to the average investor. And what we need to do is put perspective into their lives and the situation where we've been through this 3, 4, 10 times. And so therefore, help them to understand the things that are most important. If the market went down 20 or 30%, would your assets produce the same amount of income? Probably. So if they're living off that income, it's probably going to be fine. And then you say, okay, but let's say we get 4% income and 2 or 3% comes from the portfolio and 1 or 2 comes from selling something. Then we say, okay, we got our 2 or 3, that's going to be fine. But how do we make up for that 1 or 2% we need to sell? And that's what your bonds are for. And that's what your cash is for. So that when you need to go into something and sell it when the market is down, what happens when the market's down for stocks? Usually the market is up for bonds. So they'll usually appreciate 2 to 5%. So in that way, you're selling 2 to 3% or 2% to make up that difference to get to 4. And guess what? Bonds will usually be up and there'll be a place that you can sell where you're not hurting yourself in terms of your long-term return estimates.